really thought about what goes on behind the scenes when someone buys a house. Getting that home loan, it feels like this huge kind of mysterious machine sometimes, doesn't it? So many hidden parts making it all work. Today, we're going to pull back the curtain on one role that's absolutely critical, but maybe doesn't get the spotlight often: the mortgage loan processor. And our guide for this deep dive is this really amazing set of course materials. It's called Mortgage Loan Processing Mastery: FHA, VA, USDA, and Conventional Success from Application to Closing. The author is Claudia Reid, an expert in the field. Think of this as like our shortcut to really getting the nuts and bolts of this whole industry.
Exactly. And our mission here really is to pull out the key stuff, the core insights, and maybe some surprising bits from these materials. We want you, the listener, to walk away with a real foundational grasp of how a loan actually gets from A to Z, from application to closing. And crucially, why this processor role is just so indispensable in that whole dance.
Okay, let's unpack that then. Mortgage loan processor. What exactly is that role? I mean, the materials say they're the engine that moves the loan forward. That's pretty powerful.
It really is.
They call them the key liaison, too, between the borrower, the lender, the underwriter, the title company. Sounds like a hub.
Absolutely. A central hub. Their main job. Taking all the documents, verifying them, talking to everyone involved. Basically keeping the deal on track.
Keeping it moving.
Yeah. And if we zoom out a bit, look at the bigger picture, you can see where they fit in the whole loan life cycle. There are roughly 5 main stages. First, the application. That's usually the Form 1003 you mentioned, where the borrower puts down all their info.
Right, the 1003.
Then comes processing. That's their zone. This is where the processor lives and breathes. After that, it goes to underwriting. That's the risk assessment part. Then closing, getting all the final docs signed, and finally funding when the money actually changes hands. But processing, that stage is really the engine room. Collecting documents, ordering things like appraisals, getting everything organized. It's make or break time, honestly.
Make or break. Wow. So, okay, they're the engine. What are they actually doing all day? What keeps that engine running smoothly? What's a typical day look like according to this?
Oh, it's busy. And very, very specific. They're looking over those loan applications like the 1003, checking for anything missing. But it's more than just ticking boxes. They're digging in, collecting, and verifying documents.
Verifying, that sounds key.
Huge. Income docs like W-2s, pay stubs, asset docs like bank statements, ID, everything. They're also the ones ordering crucial outside services. The appraisal on the property, the title search, credit reports.
So they're coordinating a lot of moving parts.
Constantly. And communicating. Talking to the borrower, the loan officer, real estate agents, title folks, appraisers, maybe even HOAs. Their job is to bundle everything up neatly for the underwriter. Then, if the underwriter has questions or needs more info, those are called conditions, the processor has to clear them.
Okay. Clearing conditions.
Yep. And finally, they help coordinate the closing logistics. The materials really nail it by calling them the glue that holds the process together. They're literally the ones making homeownership happen day to day. Think about it. One missed signature, one communication breakdown.
Yeah, the whole thing could fall apart.
Exactly.
Yeah.
Their attention to detail, or lack of it, can be the difference between getting the keys and not.
Wow. Okay, that sounds intense and probably requires a lot of patience.
You bet.
So this raises a good question. The materials mention this career is in high demand nationwide. Why is that? And what are the benefits? It sounds specialized.
It is specialized, but it's highly valued, and yes, high demand. One big reason is flexibility, lots of remote job opportunities, which is huge these days.
Remote work. That's a big draw.
Definitely. Plus, it's a fantastic entry point into the wider world of mortgage, real estate, or finance. You learn so much. Salary-wise, the materials suggest a range of, say, $45,000 to $75,000 plus, depending on experience and location, of course.
That's a solid range.
And there's room to grow. Clear paths to move into underwriting, maybe become a loan originator, or even go into consulting. It's not just an admin job, despite maybe some misconceptions.
Right, it takes real critical thinking.
Absolutely. Problem solving is key with all the complex rules.
So besides just being diligent, what does it really take to be great at this? What skills make someone shine as a processor, according to the course?
Well, attention to detail is number one. You're juggling hundreds of pieces of paper, digital or otherwise, for each loan. It has to be meticulous.
Okay, attention to detail. What else?
Strong communication, both written and verbal. You're constantly explaining things, requesting things, clarifying things with all sorts of people. Organization and task management are huge. Multiple files, multiple deadlines. You have to be organized. And then there's document literacy. That's a big one.
Document literacy. Tell me more about that.
It's not just reading the documents, it's understanding them. Knowing what a W-2 should look like, how to read pay stubs, deciphering bank statements, understanding a credit report, spotting inconsistencies or red flags.
So, like financial detective work almost.
Kind of, yeah. And definitely time management, working under pressure, hitting those closing deadlines. But here's something I really like from the source material. It says perfection isn't required,
Ah, that's reassuring.
isn't it? What is required is a willingness to learn and genuinely care about the quality of your work, being teachable and taking pride in making sure this massive transaction goes right for someone.
That's a great perspective. Okay, so we get the core role now. How does this change depending on the type of loan? Let's dive into FHA loans first. What are they exactly?
Okay, good transition. FHA loans, they're backed by the government, specifically HUD, the Department of Housing and Urban Development. They're really designed to help folks who might not qualify for other loans, think low to moderate income buyers, or people who maybe have lower credit scores or less money for a down payment.
Okay, so aimed at broader access to homeownership. What are the specific requirements processors need to track for FHA? Seems like there'd be unique rules.
Definitely unique rules. For credit scores, for instance, you might get approved with a 580 score if you have a 3.5% down payment. It can even go down to 500, between 500 and 579 if the borrower puts down 10%.
Wow, that's quite flexible.
It is. And the debt to income ratio, the DTI, usually capped around 43%, but sometimes it can go higher if there are compensating factors.
Compensating factors, like what?
Things like having significant savings, or maybe the new house payment is actually lower than their current rent, stuff like that. Things that show stability.
Got it.
Also, the property has to be owner occupied. You have to live there. And, big one, FHA requires mortgage insurance.
Ah, mortgage insurance.
Yep, two kinds actually. UFMIP, which is upfront mortgage insurance premium paid once at closing, and then ongoing monthly MIP. For a processor, these aren't just numbers, they're critical checkpoints. Miss one detail, the loan stalls. It requires that eagle eye.
Right, and what about the paperwork and the actual steps they take for an FHA loan?
Okay, documents. You need valid ID, Social Security info, 2 years of tax returns and W-2s, pay stubs from the last 30 days, bank statements covering 60 days. Also, if someone's getting help with the down payment, you need gift letters. And of course, that signed Form 1003 application.
Standard stuff, but needs to be complete.
Absolutely. Then, key processing steps. They have to order an FHA case number through a specific lender portal. They order the FHA appraisal, and it has to be from an FHA-approved appraiser.
Okay, specific appraiser too.
Yes. And a big part of their job is clearing those common FHA conditions we mentioned. Often involves getting letters of explanation, or LOEs.
LOEs, like explaining weird stuff.
Exactly. Like, why was there a large deposit in your bank account? Or what was this credit inquiry about? The underwriter needs those gaps filled. And here's a really interesting FHA detail. The appraisal focuses heavily on MPRs, minimum property requirements.
MPRs, meaning the house itself has to meet certain standards.
Precisely. HUD standards for safety, livability, structural soundness, things like peeling paint, missing handrails, exposed electrical wiring. Those have to be fixed before closing.
Peeling paint can stop a closing.
It absolutely can. Or sometimes they can set aside money in escrow to fix it after closing, but it has to be addressed. It's a big focus for FHA.
Fascinating. So FHA has that government backing, specific property rules. How do conventional loans compare? What's different for the processor there?
Right, good question. Conventional loans are different because they're not backed by a government agency like FHA or VA. These are offered by private lenders, banks, credit unions, mortgage companies, and they generally follow guidelines set by Fannie Mae or Freddie Mac.
Fannie and Freddie, right. The big players.
Exactly. These are government-sponsored enterprises that buy mortgages, which helps standardize things. So conventional loans are often for borrowers with, say, stronger credit and stable income profiles.
So higher requirements generally.
Typically, yes. Credit score minimums are usually higher, often 620 or more. Down payments can range from as low as 3% up to 20% or more. But here's a key difference regarding mortgage insurance. If you put down less than 20% on a conventional loan, you'll likely need private mortgage insurance, or PMI.
PMI, okay. Different from FHA's MIP.
Yes, and importantly, PMI can usually be canceled later once you build up enough equity in your home. FHA's monthly MIP often lasts for the life of the loan, or at least 11 years depending on the down payment.
That's a big difference long term. What about documents for conventional?
Similar docs needed W-2s, tax returns, usually 2 years, bank statements, usually 2 months. But the process has a key difference. automated underwriting systems, or AUS.
AUS, like computers making decisions.
Sort of, yeah. It's a first pass. Fannie Mae uses Desktop Underwriter, called DU. Freddie Mac uses Loan Prospector, or LP. These systems analyze the borrower's data from the application very quickly and give it an initial finding like approve eligible or refer with caution. It speeds things up considerably compared to a fully manual review initially.
So that's a major workflow difference for the processor.
Huge difference. They still collect all the docs, but that AUS finding guides the next steps. Common conditions they handle are still things like LOEs for credit checks, updated pay stubs, or verifying employment.
Got it. Okay, so FHA, conventional. Now let's talk VA loans. The materials call it serving our veterans with precision. Sounds important. What makes VA loans stand out?
VA loans are really something special. Backed by the U.S. Department of Veterans Affairs, naturally. They're for eligible veterans, active duty service members, and sometimes surviving spouses. And the benefits are just huge. Two main ones really define VA loans.
Okay, what are they?
First, no down payment required. 0 down. 100% financing is possible.
Wow, no down payment at all.
None required by the VA. And second, no monthly mortgage insurance. None. That saves borrowers a lot of money every single month compared to FHA or low down payment conventional loans.
That is incredible. Huge advantages. So, how does someone prove they're eligible? What does the processor need?
The key document is the Certificate of Eligibility, or COE. This proves their entitlement based on their service. Processors often help get this either directly through the VA's portal or the lender system has access. They'll need supporting docs from the veteran too, like the DD 214 for those who've left service. That's their discharge paperwork.
DD 214.
Or a statement of service for someone still on active duty.
Okay. Any other unique VA requirements?
Yes, instead of a strict debt-to-income ratio cap like FHA or conventional sometimes have, the VA uses a residual income test.
Residual income, meaning leftover money.
Exactly. They calculate if the veteran has enough money left over each month after paying their mortgage, property taxes, insurance, and other debts. The required amount varies by region and family size. While there's often a guideline DTI around 41%, the residual income is the real focus. It's about ensuring the veteran isn't stretched too thin.
That seems like a really practical approach. What about appraisals for VA?
VA appraisals also focus on safety and sanitation, similar to FHA's NPRs, ensuring the home is sound. But they have something interesting called the Tidewater Initiative.
Tidewater? What's that?
If the VA appraisal comes in lower than the sales price, Tidewater allows the lender a short window to provide the appraiser with additional comparable sales data that might support the value. It gives a chance to sort of contest a low appraisal value.
Oh, that could be a deal saver.
It really can be. Common conditions processors see on VA loans. Maybe LOEs for gaps in military service needing updated income or asset docs, and showing proof that they meet that residual income test.
Okay, so we've covered the processor's main job, and then these three big loan types: FHA, conventional, and VA. It really highlights how different the paths can be, even though the goal getting the loan closed is the same.
It's fascinating, isn't it, when you line them up like that?
Yeah.
You see the parallels, meticulous document gathering, constant communication, but the specific rules diverge significantly.
Yeah, the details matter hugely.
Credit score thresholds, down payment needs, how mortgage insurance works, or doesn't, like with VA, the appraisal standards, FHA's NPRs, VA's residual income focus. A good processor needs to be fluent in all these different languages, essentially. They need to know the nuances inside out.
It's not just following a checklist, it's applying the right rules at the right time.
Exactly. Anticipating the hurdles based on the loan type, guiding the borrower through that specific maze, that's where their expertise really shines, navigating those different journeys.
So thinking about all this, what does it mean for you, our listener? Well, you've basically gotten this incredible peek behind the curtain. You've seen the intense detail, the demanding nature, but also the rewarding aspect of being a mortgage loan processor. And you understand now how loans travel different roads, government-backed routes like FHA and VA opening doors, or the private routes of conventional loans. It really is a hidden engine of the economy.
It really is. And it brings up an interesting thought to maybe leave you with. We've seen how much this job relies on precision, on care, on that deep document literacy, truly understanding complex financial paperwork. So here's the question. In a world that's getting more digital, with AI and automation starting to streamline parts of the mortgage process, how does that human element, that skill of really reading and interpreting documents and situations, remain crucial? Will it become even more valuable, especially when dealing with the unique, sometimes messy, realities of individual borrowers that algorithms might miss. Something to ponder.
That's a great point to end on. This has been a truly insightful deep dive into mortgage loan processing. It's so clear now that behind every single home loan, there's this dedicated professional making sure every I is dotted, every I is crossed, turning that dream into four walls and a roof. We really hope this gave you a fresh look, maybe a new appreciation for just how complex but vital that journey to homeownership actually is. Thanks so much for joining us on the deep dive. Until next time, keep that curiosity alive.